All right, Mr. Jeb, we are live.
All right. Welcome back to a Friday edition. This is something new to the Educated HomeBuyer Live. Josh and I are here kind of off schedule to update you on what's happening in the housing market before the weekend. If you're a buyer out there, maybe you're a seller contemplating the market, going to do a little, overview of what's happening between last time we came on and what's happening now in order to help you guys become the educated home buyer. Not expecting a large turnout here, but if you have questions, put them in the chat. And Josh, we will dive into some charts here. So let's see what we got. Here we go. Let's start here.
So really just wanted to give you guys an overview of what happened this week. Then we're going to look at the economic calendar for what's coming out next week. We don't know what that news is going to be, but we definitely know what's coming. So this week, overall, over the course of the week, a nice little improvement in mortgage rates. Rates dropped 0.11%. Purchase apps were up 1.8%. Refis were up 4.5%. So when you look at that, you do continue to see a pretty strong correlation. Not that that's a big move, Jeb, but we get a little dip down in rates. We see an increase in purchase and refinance applications. University of Michigan consumer confidence came out today. It was down to 67.4 from 77.2. That's the weakest since November of 2023. Inside that report, one-year inflation expectations were up to 3.5% from 3.2. The 5 to 10-year guess was up 0.1% month over month to 3.1%. So we talk regularly here on the show, Jeb, that the government wants that figure back to 2%. They actually look and give a little weight to what consumers are expecting because consumer expectations can anchor inflation at higher levels. It's been part of their worry. So not exactly what we wanted to see there, but definitely can see a softening consumer or at least consumer expectations in that report. Earlier in the week, we had initial jobless claims. First really decent sized jump, not a huge jump, but up to 231,000 for the weekly claims. That's something that we'll bear watching. If we're here in a month and we say, hey, we got 3 or 4 weeks in a row of that, could tell us that the job market is weakening. Yeah. Last Friday, Jeb, we had the non-farm payroll report and it was weaker than expected. That's kind of why we saw that improvement this week. Following up on that, ZipRecruiter had their quarterly earnings call, and they said hiring levels continue to be subdued and the number of people quitting their jobs also remains low. So again, what we're seeing, we're not saying that the jobs market is weak, saying it's not strong. It's somewhere in the middle. People don't want to quit. Employers don't want to hire or fire. So just seeing a lot of this meandering around the middle.
Yeah, and initial jobless claims was actually a sizable jump, sitting at 231. But one of the people that we follow, we had him on the show last year, Logan Matashami from Housing Wire, believes that we need a 4-week average of somewhere around 330,000. It's just over 330,000 jobless claims in order for the Fed to really make a cut. He believes that inflation is secondary to jobless claims. If you start to see jobless claims numbers rise, that is essentially what will cause the Fed to pivot. So it's a number that we pay a lot of attention to. But again, 1 week out of the norm isn't something that we're giving a lot of credit to at the moment. We got to continually watch it and see what that trend looks like. So Josh, taking us
Jeb, Jeb, what are your thoughts on that? I directionally, I agree with Logan. 230 it's interesting, but it's not going to move the needle. I don't think we need to get anywhere near 330 for the Fed to move on that. If we end up at 275 for 5, 6, 7 weeks in a row.
Jobless claims isn't something I follow. I mean, he's a data guy, right? And he has charts and he has trends and he has all of this stuff that he's in the minutia of it all. I would say he definitely knows it better than myself, than you. And so he has numbers that he sticks to. That's better than I do, right? So I have no numbers to stick to. I just think as it gets worse, that gives us more of a reason to pivot. So if he's saying 330 it is. Could it happen at 270 or 3? Sure. Again, he's been monitoring it for a lot longer and has the numbers. So I defer to him in that world. So this is the economic calendar for next week. So you'll notice the ones with stars beside them are potential market movers, right? They have a bigger ability, if you will, to move the market than all of the other data on there, historically speaking, traditionally speaking. So kind of go up Tuesday. You've got a lot in there. PPI can be a mover. So you got core producer price on Tuesday. They've started Fed's Powell's speech, which at this point we kind of have an idea what the Fed's going to say to some degree. And then that
They
takes
always
into
star that one
Wednesday.
because if
Yeah.
he did come out of left field with something we weren't expecting, it will move the market. He probably won't, but if he did, it would move the market.
Well, I mean, he was a little bit more hawkish or dovish last time than I think they thought he would be. It wasn't really dovish, but they expected him to be a little bit more aggressive, and he was less of that, and that actually helped move the market. Kind of started that trend that we ended up seeing after the jobs report and everything else kind of added to it. But Wednesday's really the big day, right? You see 2 stars next to CPI, right? That's core CPI is what the Fed's looking at. But we get headline and core both on Wednesday. Retail sales has the tendency to be a market mover as well. Consumer spending, people are out there spending more money. Leads to inflation, leads to higher prices, which essentially is what the Fed's trying to avoid. That in and of itself can create problems. And so, we like to see those numbers come in line with expectations or potentially come in lower, which essentially leads the Fed to kind of follow through with what we think they should be doing.
And Jeb,
in this
with
environment.
both of those on Wednesday being important, the CPI, I saw one expert analyst, and I say that serious expert analyst saying, hey, they've kind of reverse engineered the data. We have a 0.4% falling off from last year, and they expect a 0.4 coming on. So basically, you're not going to see much movement. Saw another analyst go through it and says he thinks it's going to tick down a little bit. 0.1. It's not a big mover. We're still well above what the Fed wants, but that would be a positive and could push us in the right direction. And that retail sales, Jeb, we continue to see credit card balances increasing, buy now, pay later stuff, increasing delinquencies. At a certain point, the consumer is going to hit a wall.
Yeah, and understand also when inflation, how they look at inflation, it's rounded, right? So guys, it could come in at 0.4, but it could be 0.45. And that would come in as a 0.5. That would be negative. So it would be close, but not close enough. Whereas if it comes in at point, it's rounded down, and then it's 0.4, which essentially is in line. So, small little adjustments here and rounding errors. It's not really an error, but the rounding that they use can adjust those numbers in the wrong way. So something to pay attention to. So Josh, we're going to talk about rates here in just a minute. But let's kind of just talk about it now. If I were somebody going into the weekend right now, I say I'm already under contract. Is there any reason to lock now versus potentially waiting until Tuesday, the day before CPI comes out, and lock then? Or is it worth it to float it through everything and just see what happens with the market?
Well, let's look at these candles here this week. Although we did see some increase or improvement in mortgage rates, Treasuries basically traded sideways, which is about what we expected. So I don't think you have a lot of risk between now and Wednesday. I think we're going to see more sideways, but it is a market mover. Now, it can move it in your favor. So if you're a gambler and you think it's going to move it in your favor, let's go that route. If you're not a gambler, it's generally, there's a couple of big reports every month, that payroll report and CPI being the 2 biggest, that most people, unless you are aggressive in terms of your risk tolerance, you probably just want to stay out of the way. So if you're getting something under contract this weekend, if you're already under contract, you probably want to be locked before next Wednesday, but don't really need to be rushing to do it today or Monday. But Tuesday, depending on the lender that you're working with, some lenders can lock 24 hours a day. Yeah, they probably don't want to do it at 3 a.m. for you, but that report for us comes out at 5 a.m. Pacific time, so 8 a.m. Eastern. Most lenders are not going to lock for you on Wednesday. So if you are inclined to go that route, you probably want to be locked.
I would lock
before Wednesday. Yeah,
I don't think the upside being rates going lower would be that big of a difference that it would really make or break it. And it could get worse quicker. If the number came in super hot, you could be screwed with regards to rates moving quickly to the upside. If it came in a little bit better, you're still well over what the Fed's target is. So I feel like the ability for rates to drop in a significant way is less. So I think you get less on a positive and way more for the upside if it were a negative. Just a guess,
Well,
but that would be my thought.
with that, let's talk about why all these funny lines on this chart support your belief. When we have those two red lines are showing us that is an up channel in treasury yields, mortgages follow this. So that up channel is still intact. The red candles are down near the bottom, but we have some moving averages that are support or resistance on the way down. And the same thing of that bottom trend line. If that bottom trend line holds, we will make a run all the way back up to the top. And if you happen to notice, the top of that trend line is up near 5%, which would be close to an 8% mortgage rate. So we are nearing the point where we've got a nice rundown of about 1/4 to 3/8 in interest rates, where the risk is weighted more against them getting worse than the potential for them getting better.
Yeah, good stuff. Good stuff. So that takes us into our next little chart there, Josh, looking at mortgage rates. So you mentioned at the beginning, we dropped 0.11. What does that actually mean when it comes to rates?
So it's basically 7 1/8, according to Mortgage News Daily, which is about right. Most well-qualified borrowers, if you have very little down payment, poor credit score, you can expect to pay more than that. But well-qualified borrowers, somewhere in that range. So you need to talk to your mortgage professional that knows your situation. Any of these average quotes like this, you have to take them with a grain of salt. The important one here, FHA is about 0.5% lower than that. I'm seeing FHA rates lower than this again for well-qualified borrowers. Borrowers with low credit scores could be, or manual underwrite, even higher than that. So rates are better than they were. Certainly better when people were convinced and screaming that they were going to 8%. It's an important thing to keep an eye on.
No, good stuff. So guys, as you know, we're off kind of schedule here. Just you guys asked for another week, or another day rather. Actually, you asked for another hour.
Another hour.
On Wednesday. We said it's hard to accommodate that. Jeb's schedule primarily, kids doing different things. It's tough to get in 2 hours of time. So we said we'd come back another time. Well, this was a surprise. Josh came to this morning, or came to me, said, "Hey, do you want to do this today?" Absolutely. Let's do it. So we're here before the weekend. I've got a call in 11 minutes. So we're going to answer some questions here
Speed
before
round
that comes on, and just chat with you guys. So I know we got a lot of regular viewers in here. So thank you guys for showing up on a Friday. We appreciate it. First question is going to come from Alma. Have you guys done a show on how we can use first home equity to purchase a second home? How does that work? So I haven't really done a video specifically on home equity. I've talked about refinancing, pulling out cash, but never in the sense of buying a second home with it. So Josh, maybe what are the requirements on pulling out home equity, loan to value? How much money do you need for a second home if you were going to do that?
So on a first mortgage, most programs other than VA are going to cap you at 80%. You can borrow up to 80% of your home's value. So we'll take away whatever you owe on the first. That tells you how much tappable equity you have. Now with a second, we can go to 90, 95 if you have a high tolerance for bad interest rates, or high interest rates, I should say. But I will say, best example I have is a listener to the show. We're helping out. She owns a home here in Orange, California, owes very little against a pretty good value, 1.2, 1.3 value. And we are taking a chunk of that to make a nice 20% down payment on the property in Texas. For her, she didn't like the variability of a home equity line of credit. So we're doing a home equity loan, fixed second. So she knows what her payment's going to be, how long it's going to take her to pay it off. So that's much more common in the current market, because most of the people that reach out, they're like, hey, I got a 2.9%, I got a 3.2%. They have such a great rate on that first that you don't want to give that up on a $300,000, $400,000, $500,000, $600,000 loan to access $100,000 or $200,000 to buy another property.
No, absolutely. And that's another reason why we've seen what we've seen out there in the market. Airsoft Test says, do you review specific areas for people? I'm shopping in the South Jersey area, and name some cities. So no, we don't know those markets well enough to be able to guide you. If you need a real estate professional in those markets, happy to put you in touch with somebody in the New Jersey market that understands that market, can guide you, answer some questions for you. That's your best bet. But if you have a real estate agent that you're working with already, trust that agent, that what they're telling you. If you don't trust them, find a new agent. I mean, it's really that simple, guys. It's you don't need a bunch of second opinions, as long as you have and trust the first person that you're talking to. And if you don't have that, then you probably need to find somebody to start with. Find somebody else, to start with, because you got to be able to trust that person for many reasons, but more so that they have your best interest in mind, and kind of a fiduciary, right? That they are taking your interest over their own, and helping you make the best decisions possible. So hopefully that's helpful. Josh, don't have a lot of questions. It's Friday. So, what happens if somebody, Josh, is looking over the weekend, ready to make an offer? They're not pre-approved. Maybe talk about what that looks like. And then also talk about, if you are pre-approved and you're making an offer, what does that look like? I guess I can speak to that a little bit as an agent, but I'll let you do your thing too.
Yeah, let me talk about if you haven't been pre-approved. You really should do that well ahead of going out and looking at homes. But sometimes you're driving down the road, the wife sees an open house, and you go in, and next thing you know, you're ready to write an offer and have to get pre-approved. Most mortgage people, such as myself, we do work over the weekend. It's more of an on-call thing. I'm watching my phone, I'm watching my texts, I'm watching my emails. We closed one today that 3 weeks ago. Someone pops up from the show and says, "Hey, we started with Rocket. They just sent this loan estimate over, and they want me to pay 2 points for my $500,000 loan. I do not want to do that." We opened it Monday, closed it here Friday. So I'm watching my email and text throughout the weekend. So if something comes up, we can absolutely help borrowers with that. I would say most loan officers are the same, but do that well ahead of time. So talk, Jeb, a little bit about I pre-approve one of your buyers. You have them out on a Saturday and you're ready to write an offer. What does that look like?
Yeah. So it's important, if you're out there shopping, like Josh mentioned, that you do have the pre-approval letter already kind of finished, because, again, if Josh has to pre-approve you over the weekend, he can, but it's much better if you've already provided the documentation. He can go through it kind of, not rushed, make sure there's no, I's missing the dot, T's missing the cross kind of, detail on stuff, because it makes for a much better experience. But let's just say that you are pre-approved, you're looking to write an offer. What I'm going to do is I'm going to call Josh and your loan professional, mortgage professional, and say, "Hey, Josh, we're writing an offer for this amount. We're good, confirmed. Oh, it's a little bit higher than what you approved them for. Are they good to go?" Those types of things happen. But I'm asking Josh, "Hey, can you provide me with the documentation I need to submit an offer?" When I submit an offer, I like to have the purchase agreement, the necessary disclosures that go along with it. But I also like to provide my own cover letter, kind of explaining who's buying the home, and try to put as much information I can in there without overstepping boundaries. But then in there, pre-approval letter, DU finding, desktop underwriting findings, if possible. If it's a Fannie Freddie loan, I like to provide that. And then credit report. If you have a copy of your credit report, credit scores are good. We don't attach the whole report, but we can just show, hey, scores are a nice thing for a listing agent to see. Hey, this person's well qualified, right? They've got money for the down payment because we're showing proof of funds. We're showing credit score. We're showing, pre-approval letter. Josh is also being, copied on any emails that go out to another agent, just so that, if the agent has questions, for one, he has Josh's email right there. But more often than not, I'm having Josh, or whoever that lender is, reach out to the listing agent and say, "Hey, can you just have a conversation with them, send them a video, do something in order to kind of help our offer stand out?" So
And
pretty
Jeb,
simple process.
I'm not saying this is super common, but I had 3 offers written in the last 2 days. I've talked to all 3 of those listing agents. Not that it was uncommon for me to reach out. Many times they don't answer. They're like, "Cool, great information." All 3 of them had very specific questions there about our borrower, partially because one of them was unique. The other one was the sellers were unique. They had some very specific needs, and they wanted to go through that. So it's important that your loan professional is able to be a part of that team and answer those questions, because your real estate professional doesn't know the financing details and what's possible and what's doable and what may or may not hold things up.
Good stuff. A couple other questions here. Like I said, I got a couple minutes that I only have on here, Josh, and
So we're going speed
we'll just try to
round.
knock them out. So Stephen Fitzgerald, what are the chances we'll get 3 rate cuts this year? I think at the moment, based on data out there, I think it's low that you'll see 3, just based off the Fed's probability in their own charts of what it looks like. I think we're seeing 1 at the moment. If data gets significantly worse quickly, potential. At the moment, I think the probability is pretty low. Josh, this one came in. Question we've never gotten. Would you guys recommend selling my house with an existing mortgage subject to? So what is the risk of selling your home subject to and you staying on the mortgage?
Subject to is the absolute worst thing you could ever do. You are deeding the property over. You deed the property to the new person. They get to keep your financing. So you have no ownership interest. You have no recourse against them if and when they fail to make the monthly payments and destroy your credit. If you want to do that, also that could trigger a due on sale clause if the lender wished to. Look into an all-inclusive trust deed where basically you are wrapping your loan in a new loan and leaving it in place, but they are responsible to make the payments to you where you get to keep making the payments on your mortgage. So it does the same thing, but with much more protection, because if they stop making those payments, you are aware because they're not making the payments to you. You can make the monthly payments and start foreclosure proceedings to get your house back.
Great. I could get foreclosed. Well, that's too hard to answer without knowing more detail. Josh, is it easier to refinance a VA loan versus other sorts of loans?
Versus conventional and jumbo and non-QM loans? Absolutely. Because you have a VA, you have the option to do a VA interest rate reduction refinance loan. Basically, no income verification, no appraisal required. You just have to have made your payments on time. So absolutely easier, faster, cheaper, all of the above.
All right, good stuff. I do not see my 2 o'clock on here anymore, Josh. So we're gonna keep rolling. I didn't see it.
Someone canceled on you, Jeb?
Well, it was a real estate agent having questions about real brokerage. I was going to take the call and have a conversation with him because I told him I would. I didn't want to stand them up, but I don't see it on my calendar anymore. And it was a Calendly link. And so we're just going to keep going for the moment. If I need to call him back, I'll call him back. So we've got enough people on here to kind of keep going with this. If people want to ask questions.
I'm impressed. We did this with no warning. We didn't post it. We did nothing. Just fired it out here, and we got 52 of you and a number of questions. We may have to make this a regular feature.
StreamYard needs to figure out this layout. I will say that because it's very difficult
to do on a 9-inch screen.
Yeah, it really is. ZL has a question. It says, is it true it's easy to use lawyers to bypass realtors? What factors are they not considering? Keep seeing people whine about realtors and bragging about using alternative means. So like anything, right? So in the state of California, for example, I can't speak to other states because I'm not sure how it works with real estate laws in those states. As a real estate attorney in California, you can become a broker based off of the education and experience that you've already completed as an attorney. So it's easier to get a broker's license. You can just apply and become a broker, assuming that's all accurate. It used to be that way. I assume it still is. So can they write a contract for you? Yes. But there's a couple of assumptions here. One, they need to be a member of the local board because they need access to contracts, right? So you can say, I don't want to be part of the local board. Well, if you're not part of the local board, you don't have access to the contracts that you need in order to write offers. It kind of puts you at a disadvantage to some degree. Now, you can go get these offline and whatever else, but they're not the same disclosures. If you come to me and you put an offer in on my property with a purchase agreement that's not the California Association of Realtors purchase agreement, chances are I'm going to recommend to my seller that we don't use that agreement. It's not going to be something that we would consider because the protections that are laid out in the agreement that's by the California Association of Realtors specifically protects the seller, protects the buyer, protects me as the agent. So there are protections there for everyone, and that's the reason those disclosures are there. That aside, not only do they have to be a local board, but you have to find an attorney that can not only write an offer for you, but is willing to go out and show you homes in some cases, show up for the home inspection, know how to negotiate. They're still going to charge you a fee, right? They're not doing this for free. Attorneys typically work hourly rates. I mean, my buddy who's an attorney charges somewhere around $1,000 an hour. It's going to be cheaper to use me than it is that attorney in many cases based off of how this is done. So, can you do it? Absolutely. Why are people whining? People always whine. We're a society of whiners.
Because those are the people to avoid. They're telling you, I am one of those people to avoid.
This is the whiniest society. We should just change our whole show, Josh. We just should bash on how it's a lot of people will complain about anything. It doesn't matter which side you're on. And I'm not talking politically. I'm just saying you could be for something or against something, and people that aren't for it are going to whine, and the people aren't against it are going to whine too. So you win, you lose either way, right?
Jeb, I know occasionally you listen to the Modern Wisdom podcast. I don't know if you are subscribed to his newsletter, but in his newsletter, he rails against the culture of anyone on social media. It's like no one can just make a comment. It can't just, hey, we disagree, or I think this. It's got to be snarky, and I have to be ironic and detached and not care about anything.
Everything has to be polarizing.
Cool.
And it doesn't have to be like that. But nevertheless,
Jeb,
I guess
Wesley says he would volunteer to watch a realtor bashing show. So tell him
ethically, I don't think I can bash other realtors.
The code of ethics will
code of ethics doesn't really allow me to do that. And you could say, well, Jeb, you don't need to be a realtor. You're right, but here's the dilemma. I thought about that because with all of the settling of stuff, it's like there's people that are disgruntled to some degree that the National Association of Realtors went out and settled this. Like you're supposed to have real estate agents' best interest in mind, and then you go out and settle without really either talking about the possibility of settlement and just kind of doing what you feel like is in our best interest and doing it. And I thought, well, they're probably going to lose people, right? People aren't going to become realtors or need the designation. Here's the part. If your local board requires you to be part of that national board in order to have access to the MLS. So you're somewhat screwed. Like you don't have an option until there's another MLS competitor out there. You kind of have to be part of the national deal in order to do it. So you agree to their code of ethics. So otherwise, you could get in trouble. So anyway, Josh,
we got a couple other good ones here. Jeb, answer this one for Jonathan. If I rent out my house, do I need a different home insurance coverage?
You do. You need a renter's policy, which essentially covers. So your rent,
landlord's policy.
Yeah. But the renters will need you should, as a landlord, require the renters to have a policy. But
get you evidence of the insurance with proof of you as an additional named insured.
Exactly. And then you, as the owner, there's a landlord policy that essentially covers you as having tenants in the property, right? And the reason you have both is because, for example, if somebody trips and falls and, hurts himself on the property, there's different, you need coverage for that sort of thing in order to keep yourself out of lawsuits, on top of if something burns down and all that good stuff. So the easy answer is yes. Yes, you need different insurance. Josh, how do you look at dividends? Average 2 years, the most recent payout. Can I use them to essentially up my income on my application?
Easy. Can I use them? Yes. Most recent, no. Average over 2 years, yes. So you're going to get the tax returns, what you reported over the last 2 years. And the only piece that you don't already seem to know, because you asked the question perfectly, you have to prove that you still own the assets that are generating the interest or dividend income. And then we look back at what you reported on your tax returns for the last 2 years and average that.
All right, good stuff. I know there was a question here earlier asking, I thought you guys only did this on, it said Tuesdays. Wednesdays are typical night, right? Every Wednesday, 5:00 Pacific Standard Time. Not every Wednesday. I don't want to be, the guy. You didn't do this Wednesday. You said every Wednesday.
One Wednesday,
not
4
an
years
absolute.
ago.
It's not an absolute. Most Wednesdays.
50 Wednesdays a year will be live.
Yes, at least. And so it's an hour episode. A lot of people ask, hey, can you do another hour? Because we used to do a 2 hour. So we said, hey, we'll come back another day. This is that other day. So what I would say is, if you're here now and you find any value at all, if you like a second live, do us a favor, hit that thumbs up, make a comment, let us know in the comments that you actually like it, because it will give us the the wherewithal to know what we're doing and whether or not we actually want to do this day. Does this day work? Does this time work? Is this realistic? Some of you should be at work right now, so I'm questioning what you're doing at work. But
ZL said this time works better for me than the evening, and I think ZL's at work going, I got 4 more hours on this shift. How am I going to entertain myself?
It's all good. Young has a question. Says, my stepdad is undocumented, but is married to my mother, who's a citizen. Is it possible to get a mortgage with him, my mom, and myself? Josh, so how does that work?
To get a mortgage, yes, a non-citizen can get a mortgage, but it's a foreign national loan, bigger down payment, higher interest rate, all of those things. So generally, when someone asks this question, and I believe you are asking this question, is Can I get an FHA, VA, USDA, Fannie, Freddie loan with someone who doesn't have some type of residency status? And the answer is no. Fannie and Freddie have a really long and detailed list of acceptable statuses. You don't have to be a citizen, but you do have to have a legal residency status here if we're going to use income for you to qualify.
All right. Good. Let's see here. Holly, I'm just kind of reading questions as they pop up because my screen is so small. I don't care about my realtor getting a percentage. I just don't think it's fair. The realtor doesn't push my house the way they do the higher price homes due to making less. So I would say that you need to find another realtor. I mean, if you truly know that, that's a problem, right? I mean, but if you just believe that because it's your belief that you have a lesser price house and maybe it's not selling, that they're not doing their job, then that's, that can be, that's not a fair statement. When I will tell you, I do the same marketing on properties that are 500,000 as I do for properties that are $1 million or $1.5 million, most cases. But when I say most cases, sometimes properties don't show as well. All right. So I might not spend $500 on doing a video tour of a property that just doesn't show well. It's not going to make any difference. But as far as professional photography, brochures, all of that stuff is essentially the same. Any sort of marketing that we do that goes out to the public, that's all the same. The only thing is there might be a little bit different in the marketing plan based on how the house shows, price point, that sort of thing. So you kind of have to differentiate. Anybody that says they don't do that and they do the same thing on every property, not true. Some properties are easy to walk through, easy to talk about, easy to kind of throw in social media and Instagram, and they're going to do their thing, whereas other properties just aren't. It is what it is. So you kind of have to weigh and see what that looks like. But part of your questions as a potential seller when going through that interview, if you will, is ask those questions. Like, what are you going to do to market my house? And then you might say, well, what would you do if you had $1 million house or a $2 million? Would it be any different? And then that's where they should talk about that. If they say, no, it's all the same, and it's not the same, then that's a problem. Anyway, Josh, let's see here. Where's this one? Do you think homes will be more expensive next year than this year's prices?
And then follows up in California specifically. Most of the data points that way, but even here in California, we have multiple different submarkets. If you want to say Southern California, basically from Ventura down to San Diego is a pretty monolithic market. Riverside, San Bernardino are similar, but a little bit different. But then you've got the Bay Area, we've got the whole Central Coast, we've got the Central Valley. All of those are very different markets. For the most part, all of the data does indicate to prices continuing to increase. It also points to moderating appreciation, which Jeb and I are both big fans of the idea of having maybe 1%, 2%, 3% appreciation instead of 5%, 6%, 7%. But I do think for most of California this time next year, we'll see higher prices than we do today.
Here's the caveat. I told Josh this yesterday. So my neighbor listed their house. So I bought the house that I'm in right now back in November. I closed. So it's been 6 months. My neighbor just listed their house for a crazy price across the street. It's at least $200,000 overpriced. I told Josh, I think I told you this. I told my wife, I said, if that house sells for that price, my house is going on the market like the following day but basically what I think would be a crazy number based off where they price. And if somebody, I'm out of here, man. I'll move. I'll come live with you guys. You guys should tell me in the comments where I should move to, because I'm telling you, if that property happens at that price, it's selling at least 15% above where it should.
Jeb, now you sound like the typical angry viewer where it should sell where a seller offers it and a buyer is willing to pay it.
Fair enough. Based on where it's the same floor plan that I sold 6 months ago for $200,000 less. And my property was nicer. So Take it for what it is. So that would be a 15% jump in pricing in 6 months, which is crazy. And then I'm selling. I'm going to go live in a tent. There.
Your
That's
kids will think that's awesome. We live in a tent.
For like an hour until they all go crazy. Carlos says, can I use my land as a down payment for a construction loan? And how does that work?
Yes, think of it almost like a refinance, whereas your equity is your home prevents you from having to make a down payment. The equity you have in the land, assuming it's sufficient for the loan to value requirements for that construction loan, is credited to you. You don't have to come in with additional money if the land is valuable enough relative to your entire project.
All right. Gum Niche. Do you know any successful part-time realtors? What's successful? Like, again, definitions, right? What do you deem successful? Somebody that does one transaction a year is probably a good bit of them. Somebody that makes enough off of their part-time job, more than they do on their full-time job. No, I mean, I know a lot of people that have a real estate license, but I wouldn't even deem them part-time. The majority of them, unless they're either active or they might sell a house once every 4 or 5 years.
Think about, I think this is a pretty common case. You know, my friend Allison. Allison was a full-time teacher and started selling homes on the side. And then she started selling 7, 8, 10 homes a year, which is pretty good price points here in Orange County. And she's no longer a teacher. So yes, they get successful and then they quit doing whatever else they were doing so they can do more realtoring. But most people, it's like Jeb says, they have a good job and they're like, oh, this is cool. I can sell a house a year and I get a nice little extra bonus to pay for the Hawaii vacation.
Yeah, exactly. Until now they have to negotiate their buyer's agent's commission. We'll see what that looks like. Omar says, thank you for the great info, maestros. Would you invest in a small single family home or a duplex? Which would you guys choose outside of California? Comes down to price point, comes down to profit, cash on cash return, like which is going to give you the best return. And what is it requiring you to put down on each of them, right? Can you get a better return on the duplex, or is the single family home the way to go? I think, some people would always say the duplex. Others would say, hey, I just want a single family home. Like I had an investor that would only do single family homes, wouldn't do anything else. I don't think there's a wrong answer. I just think you need to understand what your goals are. Josh, what would you say?
I have both. I love my units. If I'm just pure investment, give me units. You have your risk spread across more people. The cost per door is lower. The rents per door are lower also, but not as much lower as the price per door is. So just in terms of your rent yield relative to your cost and investment, I like units better, but I can certainly understand someone saying, I prefer the liquidity and the ease of renting out a single family residence. But for me, I like units.
Good stuff. Bill, come to Arizona. Amazing weather, few to no natural disasters, and low cost of living. Bill, I love Arizona. Outside of like 3 months a year, which I assume most people there feel the same way. Arizona's in my top 5. Southern Utah.
We decided, Jeb, we're going Southern Utah.
Southern Utah.
The other stuff. We're going Southern Utah.
Arizona.
That's where we're going.
Are in my top 5. What are the other 3 in my top 5? To be determined. I can't say either of those are number 1 because I haven't fully jumped on the idea that that could happen. So I'm just kind of holding back.
We probably shouldn't say Southern Utah because they really, among all of the states that hate Californians, Utah is in the top 5 of Californian hating.
That's fine. I hate California. I live here.
No, not California, Californian. You are a Californian.
No, dude, I'm a North Carolinian.
Well,
I got transplanted here.
Yeah. You can, when you start saying calling sales sells, then they'll go, yeah, he's not a Californian.
I've lived in California now for as long as I've lived in North Carolina. That is crazy.
Now,
that is crazy.
Jeb, what is crazy is this question. Someone asked this question. Why Southern Utah over Northern Utah?
The weather.
Bingo. That's the one and only answer.
One is the desert. The other is like full tundra.
Yeah. I'm not about the snow. No. I'm not about that snow life. Not at all.
No. You're not getting me. I'll go not to live in it. Let's see here. Are HELOCs the way to go to tap into home equity without having to refi in the current market?
A HELOC or a HELoan. So you always want your loan advisor to go through the blended rate with you. Hey, here's what you can do on a HELOC. Here's what you can do on a HELoan, which is the fixed second. So fixed term, fixed interest rate, and compare that to a refinance. For most people I'm dealing with, they want $75,000 or $100,000 and they owe 300 to 500 on their first. We're like, we're not giving up a 3% first at $400,000 to get $75,000. We're just not. So it just comes down to what is the best way to access your equity if that's the route you want to go.
All right. Zio has a question that I don't understand. What is stopping states? I got you. Okay. What is keeping states or cities from offering monetary incentives for homeowners to sell so they can charge uncapped? Them from offering incentives. I mean, well, California's in a deficit. I'm not sure
$48 billion.
I'm not sure we have any money to offer for incentives, quite frankly. But yeah, I mean, they're going to get their money either way, right? So when the new homeowner turns and the property taxes go up, they capture that new buyer at the higher rate.
But that's Jeb, we're really only talking about California. Other states don't have caps. They don't need it to turn over. They can assess you at what the value of your home is. So let's go back. We are talking about California. Well, okay. There are people that have a $1,500 tax bill on a house that would be an $8,000 tax bill if they were sold today. Warren Buffett is famous for saying, doesn't he have a place in Monarch somewhere here in?
He used to have a place in Emerald Bay, but I don't know that he still has it.
At the time, he was saying, well, he paid like $50,000 for it, 100 years ago, and his taxes were like $1,500 a year, and they should be $34,000 a year. So for properties like that, yes, might there be an incentive, a break even for the state to do that? But those people generally don't need it, and that's not solving the problem. The problem is we need the average person to move out of their house. So you say, hey, here's a $20,000 incentive, but it only gets the state $4,000 more a year. You're 5 years before you even get to break even. Factor in, the opportunity cost at 6, 7, 8 years out there for a state that Jeb so importantly pointed out doesn't have any money to spend.
But hey, you would never know that. We're offering things all over the place. In fact, we talked to Ed Pento. Ed Pento is one of the co-founders of the American Enterprise Institute, which is a what do we categorize them as? A think tank. That's right, a think tank, and they have a coalition to some degree of trying to figure out housing affordability, how to solve housing. And he goes on in our podcast, which is actually going to drop this next Tuesday, about how to solve housing affordability. But he also points out how California, for example, spends money to solve homelessness, spends a lot of money to solve homelessness and makes basically no progress. And he believes that there's ways to use that money in a better way to help create inventory, do other things. So if you're inclined at all, it's a really, I wouldn't say a dense episode, but I think there were a lot of eye-opening things in there for me, Josh, understanding housing. Like he understands housing like historically and can take you back 100 years as to why we're where we are now. And it's good stuff. I mean, it really is a really good episode. But you have to be able to focus for 40 minutes plus. So but it'll drop Tuesday. I just thought it was worth mentioning because we haven't really mentioned it. We actually recorded it about a month ago. It's Josh has been stalling.
It's challenging my editing skills.
Yeah. But anyway, so we've been on 43 minutes. So Josh, maybe another minute and a half and we'll get out of here. We don't have a lot of questions coming in. 72 people watching. If you found any value and you're on the Educated HomeBuyer channel, which at the moment, 21 of you are, hit the thumbs up. Subscribe to the channel if you haven't done so already. And if you're on my channel, Jeb Smith, do the same thing. And then once you're done doing both of those, then swap channels. Like we should see the numbers go the other way, and everybody should switch channels and thumbs up and subscribe because it does help the algorithm. It helps us. And again, it's why we're here, guys, is to provide some value on a Friday afternoon. Can someone buy points, Josh, on a USDA loan?
Absolutely. Same as any other loan. They have a full normal rate stack. You can buy points to buy the rate down. You can get a lender credit to offset your costs.
All right. Nemo says, Can you or have you guys 1031 any of your rentals to another state? Not personally, but I know people that have. It just has to be like for like. So if you're, real estate, if you will, it's got to go back into real estate, residential to residential. Typically, I think is what it has. I mean, you might be able to go commercial, Josh. I think you can go commercial. But yeah, and it has to be up in more in a higher price, right? You have to go up in value, and all the other things still apply. You got to find it within 90 days, close within 180. Is that right? Something, or is it 30 days?
I
don't
believe so.
remember.
Identify 3 of them and then move on and all that. Zofo has the most important point of the day. Beautiful, beautiful profile picture.
Fish and chips. That's where you went wrong.
Time for a pint and fish and chips. Both of those sound delicious.
He's definitely English. Which
both of them sound delicious.
Fish and chips does not sound delicious.
What's wrong
with
with
chips?
You?
The chips part sounds delicious. The pint,
give me both.
Amazing.
All of the above.
The fish part, not sure I can get. Like fried fish doesn't really do it for me.
I might head over to Eat at Joe's and have all of the above right now.
I might join you. Might tell my wife I'm not coming home until later. Just tell her I'm in a meeting. I wonder if she's watching right now. Anyway,
I assure you she is.
She just texted me, and she's clearly not watching because she didn't say anything about that. What's the best rate you can get on a second? Did we answer that question? We did.
We did not, but honestly, a million factors go into that. The second homes used to be priced the same as a primary residence. Now they are priced the same as an investment property. So at 30% down, you should be able to get good rates, but it is going to be worse than where you would be. So we let off the show 7.16 is where your 30-year fixed conforming is. You're probably going to pay a little bit higher than that unless you find there are some niche portfolio lenders, some of them regional, local in your area. I think in the earlier question, you said you're looking in Florida. Check and see if there's any local banks that are doing special deals for 30% down 800 credit score borrowers on second homes, because they may want that type of loan.
Don't Sell says, heard that Freddie Mack is bringing a new second loan. Josh, do you know anything about that?
No, and it won't be anything new or different. It'll just be that lenders can securitize and sell off their second mortgages to Fannie or Freddie. And Freddie's the one that's leading the charge on this. So it might bring the cost down a little bit, might make more players come into the game, but it's not going to be additional new products for you. It's just back end really type stuff.
All right, we're going to finish it with this question, guys. ZL says, would you agree that a housing crash will only happen when the majority believes values will keep going up? There are more housing bears than bulls to cause a crash. No, I don't believe that. I believe values would crash if inventory got exceedingly more than the demand out there to buy it. You would have to have distressed sales. You would have to have people with no equity in their property. You have to have a lot of different things. Believing values are going has nothing to do with the crash. To follow up the second part, more housing bears than bulls to cause a crash. The problem with the bears, they don't own any real estate. They can't cause a crash. They're
the geniuses that have been waiting for the perfect time to get in at 40% below market.
Yeah, they're too busy making YouTube videos and have no idea what real estate, how values and crashes values go up and crashes actually happen. So, Josh, I'll leave it to you to get us out of here. 48 minutes. This was supposed to be 10 minutes, guys.
We were going to jump in for 10. We didn't know if anyone would show up. We thought the two of us might chat to each other for 10 or 15
We really
minutes.
did. We had no idea. So
appreciate you guys showing up. Appreciate the good questions. Really, our purpose here with this Friday was to get a few more questions answered, but to let you know, we're available to help over the weekend. If you need a realtor, Jeb can get you connected anywhere in the country. If you need a second opinion, and believe it or not, many times that second opinion is, hey, you're in good hands. This looks great. And you just get some peace of mind. So if you need anything, use the referral link across the bottom. We'll get you connected with me, with another mortgage professional around the country, with a realtor. If you came in late and you just saw the questions, go back to the top of the show. If you're going to be out looking at homes over the weekend, that was really kind of wanted to differentiate this from Wednesday a little bit by saying, hey, this is what you need to know if you're out looking for homes over the weekend. So
I was trying to
accomplish that.
Josh,
I appreciate you guys being here.
There's this, right? So if you're located in any of those red states, Josh can help you. If you're in any of the black states, one of our partners can help you. And I can help you basically anywhere. Get connected if I can't serve directly. So we appreciate you being here. We hope you have an awesome weekend. If you're out looking, we hope you find the perfect home. If you're not looking and you just have questions, we'll be back next Wednesday for another week of the Educated Home Buyer Live. Until then, adios.
Amigos.